What's up, fart sniffers and butt lickers? Welcome back to Trades and Gains, the only market show where we admit the economy runs on vibes, tariffs, and whatever Apple launches every September. Today, GM looked at tariffs and said, cute, watch me raise prices. Apple, well, it's flirting with a $4 trillion market cap like it's prom night. And Warner Brothers Discovery just put a "we're listening" sign on the lot because, let's be honest, nothing screams confidence like strategic alternatives. Breathe, people. It's only Tuesday, okay? This is also powered by Investor Central Club, where you can find smart money, flow, sector heat maps, and risk alerts before your broker finishes. We value your call. Go ahead, click that link in the description if you want to sign up today. And also, if you haven't already, make sure you like, subscribe, comment your hottest take after this video, and stay tuned because we update market breaking news almost on a daily basis at this point. So, to kick things off, General Motors just showed the whole street how capitalism actually works. Tariffs go up, costs spike, and GM says, have you met MSRP? And the stock popped 15%. CFO Paul Jacobson tells the street, tariff pain is easing, it's stabilized, and surprise, guidance goes up. Why did they do right exactly, though? So one, pricing power. Trucks and full-size SUVs, when the mix tilts high margin, you can pass through more of the pain. Tariff-based mitigation. Again, lower effective base plus offsets equals a smaller hit than feared. Cost discipline. Incentives at minus 4% of ATP versus industry of minus 6.9%. They did not buy share, or they didn't buy share, they earned it in this case. We have EV right sizing as well. It took a $1.6 billion charge to scale capacity into reality for them. Translation, stop building ahead of demand. Align production with post-credit adoption. It stings now, but it protects your margins for later on. Now, the numbers that matter. FY EBIT, full year EBIT, basically raised 12 to 13 billion from the 10 to 12.5 billion that was planned. Tariff impact now is 3.5 billion to 4.5 billion, which was improved from 4 billion to 5 billion. Q3 EPS was 280, which beat revenue, and revenue at 48.6 billion. Q3 tariff costs came in at 1.1 billion, and that's after mitigation. Deliveries, they saw 710,000 vehicles, up 8% year over year, and trucks and SUVs are doing the heavy lifting. Now, why did the markets cheer? Why should you care about this? Well, guess what? They didn't wait for policy mercy. They priced, they mixed, they cut, they guided up. In a tariff regime, that's basically your playbook. So, investor takeaways for this: if you're long on GM, you're long pricing power plus operational agility here. Watch for dealer inventory creep, consumer elasticity at higher MSRPs, and the EV demand slope post-tax credit. Pairs idea, well, long GM versus weaker price power peers. Add optionality with calls into catalysts. Hedge with aluminum/steel sensitivity if tariff noises begin to spike again. Now, Apple touched fresh all-time highs, our next story, and it is closing on a $4 trillion market cap because the iPhone 17 is selling like it cures inflation right now. Early data, we're seeing up 14% year-over-year sales in the first 10 days in the US and China. Base model is up 33%. Consumers love same price, better chip, better camera, more storage. Of course they do. Apple basically sold you value, quote unquote, at, well, Apple margins, unfortunately. But what's working really? Carrier subsidies, they're nudging folks up stack. They're nudging folks up the stack. Think the Pro/Pro Max. The Air model slightly outselling last year's Plus. Great for ASPs without cannibalizing the Pro Max. China resilience, well, that's pricing plus perceived value offsetting the demand headwinds. So what's not real yet exactly, you're probably asking? Well, AI Siri 2.0. Apple delayed the big AI Siri upgrade. Meanwhile, Google/Samsung have feature momentum. Does it matter short term? Not if the iPhone 17 cycle is this strong. Again, they pushed back AI Apple Intelligence, and they were going to bring that into Siri. But again, that has been delayed, and that has been a kick in the balls to investors as of recently. But we should be looking out for news when it comes to that being developed and brought out at some point. Now, investors, Apple is at / near the $4 trillion market cap. The market's quality duration hedge. Risk, AI features keep lagging, and potential regulatory heat, which can drive the price down because if investors do get impatient, best believe they will sell off at that point. China resilience, well, pricing plus perceived value offsetting domestic headwinds here. Now, if you're chasing, stagger your entries. Consider selling downside puts to finance upside calls into the holiday quarter, because we should probably see some more iPhone 17 momentum going into Christmas and Thanksgiving this year. And also watch for carrier promos and that cadence of it, because a lot of times you will see an uptick in demand of those phones, especially when Verizon's like, oh, trade your phone in today and get an iPhone 17 on us. It's your best real-time demand tell. Think of it as your bellwether for what is going on with iPhones. For our final story, we're going to talk about Warner Brothers Discovery. It confirmed it's received buyout interest for parts of the whole enchilada, while still moving ahead with that two-company split, studio / streaming versus network / sports. The rumor mill, Netflix, Comcast, Paramount / Skydance are kicking the tires, and the stock popped. Now, why does this matter? Industrial logic. IP libraries plus scale equals leverage in streaming bundles, sports rights, and global distribution, with some debt relief too. A sale, a carve-out, or JV can de-risk the balance sheet and re-rate equity. And if you were here for our class on balance sheets, you'll know exactly why that's important. Regulatory risk. Any tie-up with big distributors or streamers equals antitrust Sudoku. Expect conditions, concessions, or even creative structures. On the trading lens, the M&A chatter adds a volume premium. If you're long WBD, trim rips / keep a core amount in your portfolio. And then the sympathy plays, look at LGF.A, Para, niche IP owners, rumor beta spreads across media typically when we see deals like this happening. Now, overall, let's talk about some macro backdrop, tariffs, China, and sector rotation. Overall, all this is going to hang in the tariff cloud. The U.S. is pressing China on rare earths, fentanyl, and soybeans. Markets are treating tariffs headlines like weather. Carry an umbrella, but keep golfing. China just printed 4.8% Q3 growth, kept afloat by factories and exports while the domestic consumer yawns. That means U.S. autos, semis, their headline risk on inputs, rare earths, and components. Energy and commodities swing with tariff heat and peace rumbles. And on the defensive rotations, staples, utilities, and Apple, the world's most expensive treasury bill right now. Now, positioning tells pricing power beats policy risk. Think of GM. Cash machines with sticky ecosystems, Apple get bid in uncertainty. And optionality in media, Warner Brothers pays when buyers are sniffing. So, the playbook. What can you take away from this? GM, they respect the re-rate. Buy dips is greater than add via call spreads into Q4. Apple, don't short great plus carriers plus holidays. That is a very risky game to play. And then on the WBD front, trade the tape with calls, okay? Don't marry the rumor, though, because that could change at any moment, as we've seen with these bundles and these deals fall apart time and time after again. In closing, capitalism's lesson this week, pricing power is policy proof. Apple sells more rectangles, GM charges more for metal, and Warner Brothers might sell the movie about it. I'm Max with Trades and Gains, sponsored by Investor Central Club again, because in a world of noise, you need a heat map, not a hot steak. I'll see you guys on Wednesday, and I hope you're having a great rest of your trading session.